Hey everyone, ever since the budget guidelines have been laid out in the parliament, I think there have been frantic calls to understand what is the impact for property investors or in general the impact of budget on people who are trying to invest in properties or in businesses, etc. What does that mean for company buying, trust buying, buying in your personal name, negative gearing? And there's a lot of hype around whether negative gearing is dead, whether buying in your personal name is dead, whether company is the only possible solution or trusts are no longer useful. So I thought of going a bit into detail about how it could work on a real-time basis. So what I've done is I'm actually trying to draw a sample case study here. Assume the facts of the case study is, let's assume you buy a $500,000 property and you keep it for about 10 years and the property doubles in value, which means you exit the property through a sale transaction for $1 million. Let's see what is the impact of this new budget guidelines if they get implemented on this transaction. The assumption here is you are buying this property after the budget has been implemented. So there's a serious caveat here. All we are talking is pretty much theoretical, pretty much on the assumption that everything that has been discussed or presented by the treasurer will get implemented. If that doesn't happen, then this conversation has no real outcome from a data or facts point of view. But this video is not necessarily about facts, it's more about the concept of buying in your personal name versus buying in a company versus buying in a trust. And is there a cookie cutter answer to every problem, or the solution has to be designed to your situation and what you're trying to achieve? So let's do a bit of a deep dive into this particular case study to understand how it could work out. So let's assume you buy something after the budget is implemented for $500,000 and you keep it for 10 years and sell it for $1 million. By simple layman terms, you have a gross capital gain of $500,000 over 10 years. From a discretionary trust point of view, you would now need to make an inflationary assumption because of the new proposed indexation method. Now, it's not a new proposed indexation method, it's been there in the past. They are bringing it back again. So let's assume 2.5 CPI adjustment every year. That's what budget is assuming. Your actual CPI could be more than that, so that would again change the impact and maybe swing it back to trust of the company. Needs to be seen. So if you look at the company ownership, the company would still get taxed at the nominal capital gain, right? So which means $1 million sale price, purchase price of $500,000. We're keeping it very simple because idea is not to go deep into the auditing of the facts. It's more about understanding the concept broadly. Company would be taxed at 30%, assuming it's a passive investment company. Your tax payable is about $150K, which means on $500,000 profit, you are paid 150 taxes and you retain 350K in the company. Now understand this 350 would stay in the company, or you would have to pay it to the shareholders through distribution or dividends, as you call it, and you would get franking credit if you design it properly. The key limitation to understand here is when you have profits in the company, you are restricted or limited by who you can distribute. So you suddenly can't decide to distribute to your kids who are above 18 and still studying at uni, not making significant income, or you can't distribute it to your parents or to any other beneficiary. It is purely to be done to the shareholders. And if it comes to change of shareholding in 10 years time, then you are anyways talking about CGT impact on the transfer of shares. So this is a critical thing for you to understand. You pay 150K taxes and you are limited in terms of how to distribute the remaining profits to the shareholders, or you can continue to keep them in the company and reinvest. Now let's talk about the same example in a trust with a 30% tax that's being proposed in the budget. So if we do that with a CPI adjustment of 2.5%, roughly give or take, your indexed cost of the property at the time of sale would turn roughly about $640,000 or $650,000, which means your taxable capital gain by that means is about 350, 360, give or take. On this profit of 360, 350, you have to pay 30% tax. So let's work through, it turns out to be around that 110, 107 kind of a number, right? I'm not going into the specifics of the numbers. It's the idea of how it will work, which means your after tax gain from this transaction is about 392 because you have paid on an indexed cost, and your tax is around 110. So if you compare the tax after indexation in the trust, it is 110, 107 versus straight 150. So you're actually saving money using the indexation method, and you are getting more flexibility around who to distribute. which means if at the time of sale you plan yourself and there is one low income operator in the family, whether it's kids, you, your partner, taking a break, whatever, you can actually plan yourself. And this is not tax advice, this is a pure planning perspective. If you speak to your financial planner, if you speak to your accountant, they are going to guide you something on similar terms, which means you can actually bring down your tax impact significantly in that scheme of things. Yes, on the other side, if you do not plan yourself properly and every single person that you distribute this profit to is on the highest tax bracket, then of course it means you would have to pay extra taxes. However, the key difference between company and trust is, in company you have zero flexibility to decide who to distribute. It's purely by the shareholding. But in a trust, you have that flexibility. In company, you can retain the profits and reinvest the profits. In the trust, there is no concept of retention. The only thing that you can retain in the trust is losses. The day trust makes profit, net profits, it has to be distributed. What is the other concept that we are talking about? If the new legislative would have not come around the 30% tax on the trust, then in that case you would be paying same 50% CGT on the trust, which means $500,000 profit, 50% CGT exemption. So that's another thing. Trust always had the CGT exemption, whether in the shape and form of 50% or in the form of indexation. So if you go back to the old model before this legislative proposal, then you would have still got 50% CGT discount and you would be taxed on 250. And because you had the flexibility to distribute, it depends on who you distribute. If you are distributing to the highest tax bracket operator, then you are of course taxed at 47. But if you've got low members in the family who are on low income group, then you have the flexibility to reduce the taxable outcome. So if you are taxed 250k at 47%, your tax is about 117, 120, which means your after tax gain is 382. So that's the difference between how it works. When a company is straight 150 tax, in a trust after indexation it's about 107. Whatever is the leftover income, you have to distribute and you have the flexibility to distribute. So if you have to conclude here at this point, then company looks simpler, it's cleaner, but it has a lot of inflexibilities in terms of what you can do with the money and how you can distribute. This is a critical thing for all of us to understand, that company is quite fixated in terms of what can be done around with the retained earnings or profit. It does have heavy legislative compliance requirements around Division 7A also. What else we should be discussing in this one? So I'm looking at the other one. I think one key important thing for you all to understand is, do not go by the hype on the media about there is only one solution to everyone. That's not how it is. Solution has to be designed around your situation, your family income, and how many members in the family. If you are a sole operator and there is no one around, maybe company is the best way to go forward. But if you are someone like me with family, young kids growing up, or you've got parents at home, you have a lot more flexibility around that side of distribution. So what else do you want to know around company and trust? Let's see, is there anything else that we should be talking about other than the key difference? There is one, which is what I want to understand. For example, companies are more suitable. Also understand, companies are in general more suitable if you are running a business or you've got staff, expenses. That's where, if you are running a passive company, then you're taxed at 30%. If you're running an active company, then your tax is about 25%. So that's where another 5% of saving comes in. But for most of the property investors who are into PAYG roles, you would possibly be looking at 30% bracket, unless you want to be more creative around having an ABN and doing some transactions so that you can show it as a active company. But again, that is driven by your accountant's advice. So you need to speak to your accountant on what is the best way to structure these companies. Division 7A risk is very real. So with companies, there's a lot of responsibility and onus that comes on directors. It's not easy to manage a company. The financial discipline is very onerous, and regulators expect directors to understand their role. So if you are not really astute around your financial discipline, maybe going down the company path is not the right thing, because you possibly will get caught by the ATO or the regulators. Now let's talk about, so we have discussed distribution, we have discussed flexibility, we have discussed tax structures. From an asset planning point of view, control point of view, succession planning point of view, trust is far superior product than a company. That's very clear. There is no argument around that. So trust wins over there. If that's the case, if it's a pure tax play, then also depending on the situation, company might have an upper hand than trust. So I think the conclusion here would be there is no one single answer. That is very important to understand. Second, these conversations that we are having is based on proposed legislative change. They are not laws yet. Third, even if everything that's being proposed gets accepted, trust would always have their role, company would always have their role, and buying in your personal name would always have their role. Negative gearing is not dead. It's just about what type of property you want to buy. Correct? Buying a brand new property is not for everyone, so you possibly lose out on that aspect if you want to go into a stable suburb. So your goals will define, and the goals should define the strategy. So don't go and start creating companies and start buying under companies just because you have heard that on YouTube. You need to actually speak to an accountant or your mortgage broker who understands these subjects in detail and get the right advice. So I think it's a good combination if you meet someone who has an accounting background, who has a banking background, and can guide you with the right questions to ask and clarify from your tax accountant. Because one thing, and this is what I've been saying for the last 3 years, banking is a serious business. Take your money and take your finances seriously, and the more seriously you deal with this subject, the better outcome it is. For me, I am very, very glad that none of my clients have bought properties in their personal name unless it was the best thing to do after a lot of thought, which means our focus has always been investing in great high quality assets. Capital growth has been of significant importance for us. We have never bought assets purely for negative gearing or making losses. So that means all our clients have always been on the right side of thinking, and which is what this budget is trying to put focus on. That stop investing in properties that are not growing in capital purely for tax refund perspective. So I think I've given you some ideas about how the company, the trust, and buying in your personal name would work, the flexibilities and inflexibilities of investing in via trust or via company, and why you can still borrow in your personal name if negative gearing is of importance. Yes, the choice of asset and where you can invest will change. So don't make your decisions based on what you're hearing on YouTube or random advice. Speak to your accountants, speak to your brokers, get some serious advice, and do speak to people who are dealing with this subject on a daily basis. That's where the best return on your investment will come. If this makes sense, leave your comments, reach out, and we are happy to have a conversation around your situation. Talk soon. Cheers. Bye.